Are you an entrepreneur grappling with the decision between incorporating or running as a sole proprietor? Let's break down what each option could mean for your business. Hi, I'm Caitlin from the Tax Force, here to guide you through the essentials of choosing between incorporating or remaining a sole proprietor in Canada. What's the best structure for your business? Each has its benefits and drawbacks, depending on your business needs, financial goals, and personal liability tolerance. Let's dive into the key differences. If you're a sole proprietor, you operate your business personally. This means you're operating as a one-man band with no shareholders or partners, and you're personally tied to your business, taking on responsibility for all financial profits and losses. Your income is included in your personal tax return and taxed at personal rates. Starting as a sole proprietor, getting started is relatively easy, and costs for setting up a sole proprietorship are generally lower than incorporating a business. As business losses can be written off against other income, you can remain in a lower personal income tax bracket. You're in charge. You get to make all the decisions with no need for approvals from shareholders or board members. Proprietorships are regulated by the provincial territorial governments, but generally to a lesser extent than corporations. Operating as a sole proprietor, you're fully liable for your business, including all debts and losses. If your business starts to become very profitable, you may pay more in personal taxes, as these rates tend to be higher than corporate tax rates. If you need or want to raise capital for your business, this might be harder to do as a sole proprietor. Many investors or banks would only lend to or invest in an incorporated business. You'll have to plan a succession plan for your business if you want to keep operating after you're gone, as net business assets can pass to your heirs, but valuable leases and contracts may not. When you form or incorporate a business, you become legally separate from it. This means that, unlike being a sole proprietor, you and the business are two different entities, and so are the financials. The corporation issues shares to the owners of the company, known as shareholders, and pays corporate income tax instead of personal. You'll need to incorporate your business by providing articles of incorporation to the Government of Canada. These documents describe the share structure of your business and help ensure that the way you set up and run your company is compliant with government rules. Thinking of incorporating? It's a great way to get some distance between your personal assets and business liabilities. If you need a loan or an investment, being incorporated may help you raise the capital you need. There are tax advantages available to businesses, as corporate tax rates are generally lower than personal income rates. If you want to retire or no longer want to run your business but don't want to see it close, you can sell your company and transfer ownership. Incorporating is less straightforward than becoming a sole proprietor. You'll need to set up things like issuing shares to the shareholders, deciding what kind of shares you'll own, and choosing directors and officers. In some cases, shareholders who are also directors may be legally liable for some company debts. If in doubt, get professional advice to help with setting up your company. Along with being a more complicated process, incorporating a business is more expensive. You can't write off business losses against your personal income, and you must be clear about expense claims. Failing to keep receipts and paperwork for expenses could result in your business being audited. There's more paperwork and admin associated with running a corporation, including filing annual reports and corporate tax returns, on top of your personal tax return. If you want to hire someone to take care of your company admin, you'll need to factor in this ongoing expense into the company budget. There are other things to consider when working for yourself, such as health coverage and retirement planning. If you're a sole proprietor, you may look at purchasing individual health coverage to bridge the gap between what's covered by provincial and territorial plans and what you pay out of pocket. If you incorporate a business and start hiring employees, you may want to offer a workplace benefits plan to provide your staff with health and dental coverage, and/or workplace wellness plans. If you're self-employed and not contributing to a workplace pension plan, you may look at setting up a registered retirement savings plan. If you run a business, consider offering your employees a retirement and savings plan. One more key thing to think about is protecting your business and/or your business partners in the event something happens to you. Life insurance for your business can be personally or corporately owned and provides a one-time tax-free payout for your business if you die. When choosing between a sole prop and incorporation, consider your long-term vision. Are you planning to expand? Do you need to raise capital? Incorporation can make these processes easier by allowing you to issue shares and attract investors. It's all about aligning with your future business goals. Thanks for watching, and remember to use the tax force.